So welcome dear learners. I would like to welcome you all to this lecture on balance of payment, its meaning and definition, and what are the difference between balance of payment and balance of trade. So this lecture is basically included in our module 11 unit 1. So let me start with introduction. So when we are talking about balance of payment, which is also known as BoP, is an essential financial statement that records a country's monetary transaction with rest of the world. So in international economics, what happens when a country engages in trade, they either import or export different goods and services. So balance of payment will basically explain or it record all those transactions within a particular period of time with the rest of the world. So that is why balance of payment always serve as an indicator of the country's trade potential, and it reflects the performance of the particular country in international competition. In other words, deterioration or improvement in balance of payment ultimately determines country's trade potential and its performance. Now, whenever we are talking about balance of payment, it encompasses all external transactions including export and import of goods and services, foreign investment, loans, foreign aid, financial transfers and capital movement. So that is why balance of payment, it includes all the external transaction. It is a summation of all those variables as I have already mentioned, such as export and import of goods and services, foreign aid, financial transfers, capital movement, etc. Now, when there is some procedure or there is some method of including all those transactions into balance of payment, which is basically, those transactions are basically recorded using a double entry bookkeeping system where every transaction is noted either as credit, that is receipt from abroad, or debit, that is payment to abroad. Now, another important thing regarding balance of payment is that it is a very whenever a country always maintain balance of payment very systematically. What they did, they systematically categorize into current account and capital account, ensuring that country's financial dealings remain balanced. Now, how you can understand as a layman or as a student of economics, how we can understand balance of payment. So as I have already told you, the balance of payment is a vital economic tool that record all financial transactions between residents of a country and the foreign nations over a specific period, usually a calendar year. So what happened? In present day world where all the countries across the world engage in trade and the volume of international trade has expanded just like anything, now maintaining a sound balance of payment is crucial for overall growth and development of a country, because it is a comprehensive account of goods, services, gift and capital flows from one country to the another country. Now, there are various definitions of balance of payment as given by various economics. For example, according to the famous economics Kindleberger, the balance of payment of a country is a systematic record of all transactions concerning goods, services, capital flows between its residents and foreign nations. Similarly, we can give the definition as given by Bentham, where Bentham defines it as a record of monetary transaction with rest of the world over a given period. So thus, balance of payment provides a clear statistical representation of countries' international economic engagement with rest of the world. Now, if you see the literature, if you see any kind of books on international economics, you always come across a line that is balance of payment is always in balance. So, why it is said and how balance of payment are always in balance? This is because balance of payment always maintains a double entry accounting. Now, when it maintains a double entry accounting, every transaction is recorded twice, once as a debit, that is outflow, and once as a credit, that is inflow. So, let me give you an example. If a country export goods, so it will consider as a credit in the current account. The payment received due to export will either increase foreign exchange reserve or be used to invest abroad. So, that will be included as a debit in the financial account. Now, what is the adjustment mechanism? There are some kind of adjustment mechanism. So, if for example, if we assume that if a particular country runs a current account deficit, that is obviously that is current account deficit means spending more on import than it earns from export. That means value of the import is comparatively higher than value of the export. Now, what will happen if a country runs a current account deficit? It must be financed by a financial account surplus, that is borrowing from abroad or selling asset, so that balance of payment should always in balance. So, reverse is the case if we are assuming that if a particular country has a current account surplus, it means that country is lending or investing abroad, so leading to a financial account deficit. Now, after explaining why balance of payment is always in balance, now we will try to explain the two related concepts in international trade, that is balance of payment and balance of trade. Now, international trade, trade basically, trade transaction primarily involve two major concepts. One, either receipt, or second one is payment. So, while both balance of payment and balance of trade deal with a country's international transaction, but they differ in scope as well as in significance. So, now we will discuss what are the differences between and what is the difference between balance of trade and balance of payment and how they are related to each other. Now, whenever we are talking about balance of trade, we have to remember that it is a narrower concept, because the amount of component included in balance of trade is comparatively less. But in compared to balance of trade, balance of payment is comparatively is a broader concept, because the amount of component included in balance of payment is comparatively higher as that of balance of trade. Now, whenever we are talking about balance of trade, it basically focuses solely on the export and import of physical goods. So that is why, but in case of balance of payment, it includes not only trade in goods, but also financial transaction and capital transfer, which are not included in balance of trade, because balance of trade always include only the physical goods. Now, obviously, since it is included only the physical goods, it may be either in surplus. When we say, when it is in surplus, we usually say that balance of trade, is in a favorable position. The country's balance of trade in a favorable position, and when the balance of trade is in a deficit position, we used to say that balance of trade is in unfavorable position. So similarly, but in case of in case of balance of payment, what we usually said, as I have already explained, in case of balance of payment, it is always said that balance of payment always in balance from an accounting perspective. Now, what happened? Suppose if we are assuming that, and as I have already explained, balance of trade can be favorable, that is, country is earning some kind of surplus. Balance of payment unfavorable, that means country is incurring some kind of deficit. Now, what will happen in that case? A deficit in the balance of trade can be offset by the balance of payment. If a country incurs some kind of deficit in the balance of trade, it must be offset by the balance of payment. But a deficit reverse is not true. A deficit in the balance of payment cannot be met by the balance of trade alone. There is another important differences between balance of trade and balance of payment. Now, when we are talking about balance of trade, it provides only a partial view of a country's economic position, because balance of trade is a narrower concept. But if you say the balance of payment, it provides a complete view of a country's economic standing. So these are the differences between balance of trade and balance of payment. So as a student of economics, we need to know and we need to differentiate what are the differences, the basic differences between balance of trade and balance of payment. Now, when we are talking about balance of payment, we should be we should remember the fact that the balance of payment is basically influenced by various factors. Now, the two crucial factors which determine the balance of payment position of a country is basically fiscal policy and monetary policy, and the interplay between these policies has an impact on balance of payment. Now, whenever you are talking about fiscal policy is basically refers to the government spending and taxation to influence the economy. In other words, it is basically the difference between spending of the government and the taxation collected from different sources. Now, if there is a mismatch between taxation and spending, that means revenue and expenditure, then fiscal, what government used to do, they take some kind of borrowings. Now, all these kind of activities has an impact on the balance of payment position of a country. So now when government spending is comparatively high, and amount of taxes is comparatively low, it is known as expansionary fiscal policy. That means in case of expansionary fiscal policies, what government used to do, government used to spend more for overall development of the economy. So now this expansionary fiscal policy has an impact on the balance of payment of position of a country. Now, what will happen in case of expansionary fiscal policy? In case of expansionary fiscal policy, this is basically, from fiscal literature, if you see, this is basically government used to spend more when there is a problem of deflation. To revive the economy, as explained by John Maynard Keynes, what government used to do, government used to spend more. So as a result, when government used to spend more, it will increase the total output, and it will also create some kind of employment opportunities to the people, and as a result, government can bring the economy out of the deflationary situation. Now, when there is an expansionary fiscal policy, what happens? It increases demand for import. And as a result, when there is an increase in the demand for import as compared to export, it worsens or it deteriorates the current account deficit. And as a result, in case of expansionary fiscal policy, what is basically happens? Expansionary fiscal policy can attract foreign capital inflows, that is financial account surplus. So that is why expansionary fiscal policy has an impact in terms of worsening the current account deficit because of higher spending as compared to taxes. Now, the reverse is the case when government used to do contractionary fiscal policy. Now, what is contractionary fiscal policy? Contractionary fiscal policy is basically lower spending and higher taxes. So basically, this policy is contractionary policy is adopted by the government when there is a problem of inflationary pressure in the economy. So when there is a problem of inflationary pressure in the economy, what the government wants to do? Government wants to reduce the prices of the commodities. So how can they reduce the prices of the commodity? They want to reduce the aggregate demand in the economy. So when aggregate demand in the economy comparatively reduces as per the supply, then what will happen? The prices will automatically decline. So this kind of fiscal policy is adopted or is taken by the government when there is a problem of inflationary pressure. Now, in case of contractionary fiscal policy, as the name suggests itself, there is lower spending but higher taxes. So when more taxes are imposed on the people or the citizen, what will happen? Their disposable income will decline, and as there is a decline in the disposable income, they cannot create demand. So as a result, what will aggregate demand will decrease, and it is believed that the reduction in aggregate demand will have an impact or has a positive impact in controlling the inflationary pressure. Now, in case of contractionary fiscal policy, obviously it reduces the demand for import in the context of balance of payment. So when there is a decline in the demand for import, it will improve the current account. It will improve the position of the current account in balance of payment, but it has an impact that it may lower the foreign investment inflows. So that is the impact of contractionary fiscal policy on balance of payment. In case of expansionary fiscal policy, it may worsen the current account deficit because of increase in import, and in case of contractionary fiscal policy, it may improve the current account position because reduction in the demand for import. Now, after discussing the impact of monetary policy or fiscal policy on balance of payment, we will now try to explain what is the impact of monetary policy on balance of payment. Now, what is monetary policy? Monetary policy, in simple language, it refers to the central bank actions, that is actions on interest rate, money supply, to control inflation and economic growth. Now, whenever we are talking about central bank, in case of India, it is Reserve Bank of India. Now, if you want to explain monetary policy in case of India, that means the policy which is basically adopted by Reserve Bank of India from time to time to influence the overall condition of the economy. So those policies are basically bank rate, repo rate, reserve repo rate, which has an impact on overall interest rate, money supply. So those are basically policy related to monetary policy. Now, monetary policy has an impact on balance of payment through two ways, either expansionary, what will be the impact of expansionary monetary policy on balance of payment, and what will be the impact of contractionary monetary policy on balance of payment. Now, what happens in case of expansionary monetary policy, that is, what is expansionary monetary policy? That is lower interest rate. They want to reduce the interest rate so that the people will invest more. And how we can reduce the interest rate? They will try to, the Reserve Bank of India will increase the money supply so that it has an impact on interest rate. Now, in case of expansionary monetary policy, what will happen? It will depreciate currency. The currency will depreciate and export become cheaper, and it will improve current account. So that is the impact of expansionary monetary policy. It results in depreciation in the currency, and export become more cheaper, and it improves current account. Now, as a result, what happen? It can reduce investment if returns fall. So that is why in case of expansionary fiscal policy, export become more cheaper and it improves current account. Now, in case of contractionary monetary policy, That means contractionary monetary policy can be explained in terms of higher interest rate, reduce money supply. Government want to they want to contract or reduce the money supply into the economy or into the money supply in circulation. The result of contractionary monetary policy is basically it has an impact in terms of appreciation in the currency of that particular country. And as a result, what will happen? Export become more expensive and it worsen current account. When export become more expensive, obviously it will worsen current account because exports are more dearer than import. But the impact of contractionary monetary policy is that it attract foreign capital and improve financial account. Because of higher interest rate, obviously it will attract foreign capital. Now, if you see the whole game, the balance of payment of position of a country is basically a interplay between this monetary policy and fiscal policy. So that is why it is also in if you see in fiscal literature, it is known as twin deficit hypothesis. That is it is basically called a fiscal deficit often leads to a current account deficit, and it is always said that there is some kind of coordination between monetary and fiscal policy, so that we can maintain a healthy balance of payment. Now, what happened? Let us consider a situation. What will happen if both the policies are expansionary in nature? That is monetary policy, which is basically taken by Reserve Bank of India, and fiscal policy, which is basically taken by Government of India in terms of taxes, non-taxes, in terms of expenditure. Now, if both the policies are expansionary, that means government is spending more as compared to taxes on terms of fiscal spare. And expansionary fiscal policy, monetary policy means government will reduce the interest rate, and increase money supply. And what will happen? So if those kind of policies are adopted by the government, the balance of payment deficit may worsen. And if both the policies are contractionary, the balance of payment position may improve. Now, after discussing the impact of monetary and fiscal policy on balance of payment, we are in a position to discuss what are the components of balance of payment. Now, as I have already explained many times, the balance of payment is structured. It always is structured using a double entry bookkeeping method and is divided into three main sections. So, what are those three main sections? The current account, the capital account, and the official reserve transaction. Now, whenever you are talking about current account, the current account records all transactions related to the export and import of goods and services as well as unilateral transfers. So, it can be represented by, if you want to explain the current account in terms of a formula, then current account is equal to visible plus invisible export minus visible plus invisible import. So, this is the simplest formula of current account. Now, if you want to discuss what are the components of current account, it basically includes the merchandise trade balance. So, this includes the trade of tangible goods. Current account also include the service trade balance. Service trade balance means it includes trade of intangible goods such as commercial services, travel, transportation, insurance, and income from foreign investment. These are basically service related balance. Now, what are the unilateral transfers? Unilateral transfers, it basically involve one-sided payment such as gift, donations, pensions, and foreign aid. Now, what will happen when there is a surplus in the current account and when it occurs? A surplus in the current account occurs when the nation's export or the value of export exceed its import. So, it indicating favorable trade condition. Now, conversely, A deficit in the current account arises when imports surpass export, leading to financial imbalances. Now, after discussing the first component of balance of payment, now we will discuss the second important component of balance of payment, that is capital account. Now, what is capital account? While the current account reflects a nation's net income, the capital account records the net change in ownership of national assets. So, that is why it includes both short term and long term capital movement. Now, if you see, after deregulation of capital movement after the economic reforms in India also, there is a huge flow of capital from one countries to other countries. So, that is why it is very important to discuss the movement of capital from one country to another country and its impact on balance of payment. Now, when we are talking about capital account, it basically includes in both private and government. So, what are the private transaction? Private transaction, this include basically direct investment, portfolio investment and short term investment. Now, what is government transaction? Government transaction, this basically consists of loan to and from foreign official agencies. So, that is why capital account, capital can be both from private institution and as well as from government institution. Now, this capital account, it basically monitors the financial transaction that impact countries' foreign assets and liabilities. Now, transactions that bring foreign capital into the country are recorded as credit, while outflows of capital are recorded as debit. The balance on the capital account is determined by the net value of foreign direct investment and portfolio investment. Now, whenever we are talking about foreign direct investment, FDI and portfolio investment, we need to know what is foreign direct investment and portfolio investment. But I will not explain this in detail here. It will be basically foreign direct investment is of a kind of a long term investment, but portfolio investment we consider to be a short term nature. We will not explain detail here. It will be explained in one of the class in this MOOC. Now, after discussing current and capital account, we will discuss the official reserve transaction. Now, what is official reserve transaction? Unlike other transaction, official reserve transaction are executed solely by the government to manage the nation's economic policies. So, that is why this section records changes in a country's liquidity and non-liquid liabilities. It also includes a nation's official reserve assets over a given period. So, that is why what happened, an increase in official reserve is recorded as a positive entry, while a decrease is marked as a negative entry in the balance of payment account. So, that is why what are the components, when we were talking about what are the components of balance of payment. So, the first component is current account, the second component is capital account and third component is official reserve transaction. Now, another very important component of balance of payment is the errors and omissions. Now, what is errors and omissions? Why we include errors and omission as a component of balance of payment? This is because the balance of payment must always balance due to the principles of double entry bookkeeping. Since every item is entry, whenever and if you enter any item is either you can enter the item as a credit or as well as a debit. However, while doing entry process in balance of payment, some kind of discrepancies may occur. So, this discrepancy may arise due to statistical error, unaccounted transaction or timing differences. So that is why errors and omission act as an adjustment tool to ensure that total credit and debit remain equal, so that balance of payment are always in balance. So these are basically the components of balance of payment. Now, in conclusion, what we can say after discussing, what balance of payment all about, in conclusion, what we can say, balance of payment ultimately decide the country's transaction with rest of the world, and it is always considered as a crucial indicator of a country's economic stability and international financial standing. Improvement or deterioration in the balance of payment will decide the country's availability of foreign reserve. A fall in the position of balance of payment may result in decline in the foreign exchange reserve of a particular country, because it comprehensively record, and whenever we are talking about balance of payment, it comprehensively record all economic transaction, providing insight into trade balances, capital movement and reserve management. So that is why we need to understand the balance of payment, because understanding the balance of payment help to policymakers and economics to formulate strategies to manage trade deficit, stabilize currency values and foster economic growth. Along with that, we need to know the distinction between balance of payment and balance of trade, as well as to analyzing its core component, because by doing so, the countries can make informed decision making to ensure a robust and competitive position in the global economy. So another important things we have learned from this lecture is that both balance of payment, fiscal policy and monetary policy are interrelated to each other, and whether a fiscal policy or monetary policy is expansionary or contractionary, it has either a positive or negative impact on balance of payment. So these are the conclusions of this lecture. I thank you all for attending this lecture. Thank you.